think that's enough time for people to start joining. Enough people to have joined, and anyone that joins can keep coming later. So, Assalamu alaikum all. Welcome to another segment of the special Sanato Tijarat talks. Today we have with us Dr. Wasim Khan Saab, who will be giving an introduction to Islamic investments. Just before I do go into his introduction, just a few house rules. If I can ask everyone to please mute yourself, please save your questions until the end, and also to keep your cameras off. So, Jazakallah, Dr. Wasim Khan, for being with us today. Just for everyone else's information, a bit of background into Dr. Wasim Khan Saab. He holds a PhD in economics from UCLA and the Executive MBA from Stanford. He's got over 35 years of investment banking and asset management across Los Angeles, New York, London, Abu Dhabi, and Kuwait. He's also managed a $75 million private equity fund in the African food sector. He's deeply involved in the Islamic finance. He's contributed to the founding of Abu Dhabi Islamic Bank and has lectured internationally to financial institutions and policymakers. So I think this is a very brief introduction to a very long-standing career that he's got, where he's been involved in much, much more than this. But we were just able to squeeze this in. So without further ado, I'd like to Wasim Khan Saab, if you could take the floor.
Assalamu alaikum wa rahmatullahi wa barakatuh. Shoaib Saab, Jazakallah for that introduction. And without further waste of time, I will delve directly into Islamic investments. The first thing that I want to point out is the first slide in here, which says the concept of Islamic finance. And what we need to understand is how Islamic finance differs from conventional finance. And I'm going to go into a little bit more depth later on in this presentation. But what we need to understand is that Islamic finance is underpinned by religious principles. And these are the principles that come in from the revelation, which is the Holy Quran, the Sunnah, and Ijtihad. Ijtihad essentially means that how over the years, over time periods, different religious scholars have interpreted the guidance from the Holy Quran and the Sunnah. Whereas in conventional finance is based upon commercial principles, what we see where interest rate plays a pivotal role. And what we see today in conventional finance is what has come across over the last 100, 150, 200 years, maybe even more. And it has evolved over this period. It has had regular shocks into the system, after which it stabilizes, finds a new equilibrium, and then another shock hits it, and loopholes show up, and then the authorities plug those loopholes, and this is how it is where it is today. So there is no underlying religious principles in the conventional system. It's only in the Islamic system that is, and I think that that's an important point that we need to keep in mind when we look at the concept of Islamic finance, Islamic investments. The second slide essentially says that obviously, the Sharia law, which is a blueprint for mankind and governs all aspects of human life, including economic, cultural, political, social, and how we derive. And it's important also to understand that there are various schools of thought within Islam, and the interpretation of what comes from the Holy Quran and Sunnah, and the interpretation can differ. For example, the Hanafi fiqh is essentially a little bit more conservative, whereas the Shafi and Maliki fiqh are a little bit more liberal in that size. And then our brothers in the Jafri or Jafari fiqh, which is the Shia fiqh, have slightly own interpretations of them. So Islamic finance, Islamic banking, which is being currently practiced in these different countries, are basically tempered a bit here and there by the school of thought that is prevalent in those countries. So we need to keep that in mind as days. Now, let me delve into the basic model of Islamic finance, which is essentially the Islamic banking finance paradigm. The basis of Islamic finance is equity and justice. Now, Equity and justice is something that has been reiterated by Khalifa Abak and his predecessors time in and time again, that equity and justice must prevail in this world. When we talk about equity and justice within the Islamic finance paradigm, we are talking about social justice, which means that there's equal opportunities for all in all walks of life, regardless of the background. We talk about legal justice, that all are the same in front of the law, regardless of the status, their race, their caste, their creed, their religion. The law provides protection, opportunities, and freedom. That's legal justice. And of course, economic justice, which essentially means that the right to procurement, rights to factor of production, and distribution, property rights are the same for everyone. So that essentially is the foremost pillar. If you look at the Holy Quran in Al Hadid, verse 57:25, Allah subhanahu wa ta'ala says, we sent our messages with the clear signs, the scripture, and the balance so that people could uphold justice. And I think that's a very, very powerful statement that we have there to prove that. A lot of people think that the difference between Islamic finance and non-Islamic finance is essentially that in Islamic finance there's no riba. Riba means interest rate, whereas in conventional finance, which is interest. That's true, but that's one difference in there. What is riba? Riba is excess money. It's unearned reward for lending money. Uh, it is usurious if you look at in certain countries in Indian subcontinent elsewhere, times immemorial, you've seen that families for generations and generations have been burdened by what they have borrowed and what they should be lending, but interest compounds, interest builds upon interest, and these people are bonded forever. These are bonded for generations. And that is what is usury, and that is what Islam doesn't like. And that's where it says in many places, but I've quoted Surah An-Nisa, where Allah subhanahu wa ta'ala says, and for practicing usury, which is forbidden for consuming the people's money illicitly, we have prepared for the disbelievers among them painful retribution. And I think that this is a very, very powerful statement that we have, that is a guidance to us in terms of interest rates or usury. Look at some of the I mentioned about the families. Look at some of the countries that have been burdened by debt crisis and by interest rates. You don't have to go back too far. 30 years ago, you had the Latin American debt crisis. Then you had the Mexican debt crisis. Then in 2010 and 12, you had the European debt crisis, which started from Greece and even in Gulf countries like Spain and Belgium and even Italy and Ireland into it. So there was this overhang of high interest rates, a lot of money that was given to them in terms of loans. And then these countries were not able to pay back. And you had a huge debt crisis within the world. And those of you who have been in the investment market, who dealt with bonds of these countries, you know exactly what I'm talking about. That is where the problems have been. And within the countries, just like as families have felt devastating consequences of debt and of compounding interest rates, countries have felt the same thing, which have meant that the economies of these countries have been destroyed, unemployment has risen, inflation has risen, people have lost jobs, and people and the whole country has been devastated because of these things. So what does Islam provide us? Islam provides us an alternative to interest rates. Islam says it's profit and loss sharing, and we understand that. Now, what is profit and loss sharing? Now, profit and loss sharing basically essentially means that in Islam, and I want to be very clear on this, is that profit is shared according to a pre-agreed ratio, not a lump sum money, but a pre-agreed ratio. So let's say, for example, you are the financier, I am the worker. You and I agree that you will provide the finance, I will work on a particular project. And if we make money, we share 60-40. You get 60 for providing the finance, I get 40 for my sweat and my hard work, right? So we agree on that ratio. But the loss ratio is determined by the amount of capital contributed. So if I don't contribute any capital and there's a loss, and you have contributed 100% of the capital, then you will pick up the loss, all of the loss. But if I've contributed 30% of the capital and you have contributed 70% of capital, then our loss will be shared 70-30. So these are two distinct factors that we need to be cognizant of within the profit and loss sharing agreement. The next one is contracts and trust. Everything in this life has a contract. When a person is born, they get citizenship of a country, they have a contract with that country, then when they grow up, they'll be law-abiding citizens of that country. That is exactly what the form states when you fill that form out for your passports in most countries. When you go to school, your parents sign off on the forms, which is a contract that you will abide by the rules and regulations of that school, and you will study and work hard and be a good student. Same thing when you go to university. When you sign up for a job, you have a contract with your employer. And when you get married, you have a marriage contract, which is a nikah. And boy, oh boy, if you step aside from that contract, you're going to be in the doghouse forever. So the trust in these contracts is very important, be the financial contracts, be the other contracts. Trust is very important. If there's no trust in the contract doesn't work. Amana, which is a trust, or amana, which is also the trust that's placed in when people have keep some money or anything else with you. That trust is very, very important. Allah subhanahu wa ta'ala says in the Quran, Inna Allah yamurukum an tawaddu wa la amanta te ila ahliha wa iza hukmatum bain an-nasi an tuhikmu bil adl. And the translation is that verily Allah commands that you should render back amana, the trust, to those to whom they are due, and that when you judge between men, you judge with justice. So justice has to prevail, trust has to be in the contracts to move forward. The fifth element is prohibition of gharar and maisir. So what is gharar? Gharar means uncertainty in contracts. Islam says that there should be no uncertainty in contracts. It should be fully transparent. Both parties or three parties, whoever are there, we should fully know what they're working with, if there is something being purchased, what is being purchased, what is the quality of that, when is the delivery time, how much money is going to be paid, so on and so forth. So gharar essentially means uncertainty, which is risk. And Islam does not like that. Islam says that there should be no gharar in this. We talk about some, those who are involved in the financial markets. We talk about efficient markets. And they are not really very efficient markets because a lot of information is being held from investors by those who are participants in these markets. That's why it gives rise to things like insider trading in the stock markets and so on and so forth. So there is there. There is information that is being withheld. Now, having said that, the next one is basically maisir. Maisir is an Arabic word which means speculation, a game of chance. Islam says that you should not be investing in something where speculation is involved. For example, a lot of people talk about cryptocurrencies. To me, cryptocurrency is not a currency, is not an asset. It's a pure tool for speculation. And that's why it's forbidden in haram, something like that. Sometimes people buy lottery tickets, and that is unfair. You may lose the money, or you may win at the expense of all the others who bought the lottery tickets. Qimar means gambling, which again is lottery, where things may not exist. For example, short selling is qimar. Those of you who work in the financial markets, especially in the equity markets, you will recognize that there's always a short position taken against companies that are vulnerable because people borrow these stocks, sell them on the market with the hope that the price of these stocks will go down further and they'll buy them back and return it to the lender and make the difference as a profit for themselves. But when markets don't behave the way they expect, you get what you call as a market as a short squeeze, and then these people get shorted out and they lose money. So that is the then underlying economic activity. Underlying activity essentially means that every transaction in Islam needs to have underlying economic activity. Money cannot be used to buy and sell paper products. There's no, for example, equity derivatives, bond derivatives. These are paper transactions, and these are not allowed in Islam. Islam requires that any transaction should have economic activity that benefits the two or three parties that are involved in this activity, plus the society at large. So Islam also talks about the society at large. Property rights and lawful wealth. Property rights are legal in Islam. These contracts are legal in Islam. Wealth accumulation is basically that in Islam, wealth is accumulated through hard work, and wealth can be accumulated through inheritance. But unlawful wealth accumulation, i.e., by encroaching upon the rights of the orphans and the widows and others, that's not allowed in Islam. And lastly, but not least, zakat. Zakat benefits the society at large. If you look at the model that was used by Hazrat Umar bin Farooq in Riyasat Medina, which was the model for receiving zakat and distributing it to the needy, that by historians is the model on which the welfare system in the Western world is built. Hazrat Umar had created the Baitul Mal, in which zakat donations were made by the Muslims, and the taxes paid by sorry, I need to turn this off. And jizya, which was a tax paid by the non-Muslims, was accumulated and distributed to the widows and the orphans, the disabled, soldiers' pensions, so on and so forth. But there's two very important things in that. One of them was leadership, and the leadership provided by Hazrat Umar. And the second thing was accountability. There's a saying that Hazrat Umar once said that if a dog sleeps hungry on the other side of the Euphrates River, I'm going to be responsible for that. Accountability was very important. In the people that were made responsible for receiving the zakat and the jizya tax and distributing it, they were accountable to the Khalifa. And if there was any misappropriation, they were brought to justice. So just to try to build this up on what Mansoor Manan Saab talked about in the first talk, these are the pillars of Islamic finance and banking plan we have. I'll just move on to the next one now. And I'll give a comparison of the financial system, the conventional Islamic financial system. So the conventional system is not based on any religious concepts. The Islamic system is based on the religious concept that we just talked about. Interest rates are the pivotal factor in the conventional system. In the Islamic system, there's no interest rates. It's profit and loss sharing. In the conventional system, debt contracts are issued and traded. That's bonds, for example, issued and traded. In Islam, there's no debt contracts, so no bonds, and hence there's nothing traded. In the conventional system, impact on savings and investments can be considerable. The volatility in returns can be very high within the markets. In Islam, there could be volatility, but it's moderate because it's based upon profit sharing. In the conventional system, monetary policy regulates interest rates to achieve growth, employment, and other goals of the economy. In the Islamic system, monetary policy regulates the money supply and allows economic growth, employment, inflation to react to that, to work that. In the convention system, there's a mismatch between asset and liability maturities. Take, for example, the case of a bank. A bank will usually work off on a regular yield curve, which means that it will borrow short term on low interest rates and lend long term on higher rates. So they make the difference. But if things turn wrong, and if the central bank raises interest rates, the short term rates could go up very high compared to long term rates, and the banks can lose money. In Islam, in the Islamic financial system, you don't have that. There's no mismatch in the underlying in assets and liabilities. Your exposed profits from a venture will cover the returns on the liabilities. There's other factors in there that I can go through, but in the interest of time, I won't. But one of the things is that the second last one that I will reiterate, which is that in the conventional system, you need institutions for debt restructuring, like I mentioned earlier on, the Latin American debt crisis, the European debt crisis of 2010, 2012, the Mexican debt crisis of the 90s, their sovereign debt restructuring, which is a big problem. In Islam, you don't have the debt, and there's no debt restructuring. Institutions are not regulated. And this is very important. The reason for that is because when you have debt restructuring, that takes a toll on the local economy and the people of that country. In Islam, there's moderation and compassion, and you don't have that effect. The other thing I want to mention is here is the concept of money in Islam. And I think that this concept is very important. Money in Islam is not considered to be capital, it's potential capital. It needs transformed into capital by, by activity. So you need to invest. This goes back to the earlier pillar, which I mentioned earlier on, that for every transaction, there has to be an economic activity. And this economic activity has to benefit not only the parties involved in the activity, but the society at large. If you remember in Econ 101, we used to read that money is a measure and a medium and a standard and a store. In Islam, yes, it's a standard because you can compare products and services in terms of money. Yeah. Or it's a measure you can value product or service. It's a medium, yes, it facilitates the purchase and sale of goods and services, but it's not a store. Money is not a store in Islam because Islam does not like idle cash balances. Money is the lifeblood of the economy. It has to remain in circulation. You cannot put money under the mattress and leave it there. That money has to be in circulation. You can put it in a savings account with a bank, Islamic bank, and Islamic bank will invest that, according to it's in the Islamic Sharia compliant products that it will. So you get a profit, they get a profit. Islamic investments. Let me get into the main part of this once I've said in the background. Again, as I mentioned earlier on, it's a very vast subject, so I'm just skimming the surface of these just in order to ensure that I set up the background for investments. Islamic investments, be they assets, be they funds, be they companies, be they businesses, are those that derive the income from ethical practices and halal activities. And they can be then potentially considered part of the Islamic investment menu. Who sets the standards for being there? There's a self-regulatory body for the Islamic financial institutions called the AAOIFI, which is the Accounting and Auditing Organization for Islamic Financial Institutions, which sets the standard for the screening processes. Now, let me move forward. You have three types of, you have permissible Islamic investments. You can have short-term money markets instruments, you can have stocks, you can have sukuks, high equity participation certificates, you can have property, residential, commercial, direct investment, venture capital, startups. They can all be, they're all types of permissible Islamic investments as long as they comply with the AAOIFI screening, the screens that they are compliant with the Sharia principles, and that they have to be from halal activities. Uh, they should exclude pork, alcohol, tobacco, weapons, pornography, production and distribution, gambling, interest-based financial activity, i.e., putting money in conventional banks, financial companies, and so on and so forth. They have to be in ethical practice. What does ethical practice mean? Ethical practice means that if you have a business selling samosas, the meat in those samosas should actually be come in from mutton or beef or chicken, not from rats, as in some countries that they do. You can have a chemical business where you dispose of the residue of those chemicals appropriately and not dispose them off in the local river so that it affects the people who use the water of that river or it destroys the people, their skin, the people, their health, the crops and everything else. So it has to be ethical practice. It has to be halal activity. And you have to ensure that the returns that come onto your investment come in from that halal activity. Let's look at some money market funds before I go on further. You can have these are short-term funds that are Islamic funds. This could be current account, Islamic money market funds, Muraba sales contracts, Islamic T-bills, short-term sukuks, and so on and so forth. I'm just going through this very, very quickly, but I just want to make sure that I cover these because these are important concepts there. These are short-term. They have a maturity structure of anywhere from 3 months to 6 months to 12 months. They are liquid. You can sell them and you can raise money, cash, if you need to. You can keep cash, a non-profit, no return, non-profit bearing current account within Islamic bank, which is fine. And you can do that. Then you have stocks and equities. And the screening criteria for these stocks and equities, beside the fact that they have to come from halal activities, they have to come from ethical practices, and some of the now one thing we have to understand that there's no business in the world which is not leveraged. Every business has some kind of borrowing. So in order to, if we were to be very Puritan and very strict about it, then we would not invest in any company or any stock. But the jurists have found a way around it, and they said that yes, we can, as long as certain conditions are met. So one of the conditions is that debt. Now, every company, as I said, has debt, but how much debt does a company take on compared to its assets, compared to its market capitalization? So the screening for including the stock of a company or any equity is, for example, total debt to market capitalization. It has to be less than 33%. S&P 500, FTSE, Islamic funds that they have use that criteria. MSCI, which is the Morgan Stanley Capital International Index, they use a similar criteria, but they use total debt to total assets. The different total debt to total assets is something which shows your balance sheet leverage, which shows what proportion of the assets is being financed by debt. The lower the ratio, the more compliant with the Islamic principles. Market cap is a bit sensitive to market fluctuations, but a lower ratio there is preferred. Cash, going back, cash by itself, idle balances are not permissible in Islam. Therefore, cash on the balance sheet of the company must be less than 80%. Cash, interest-bearing securities, market capital to market capitalization, the ratio should be less than 33%. Accounts receivable to market capitalization, less than 49%. Now, having said that, you'll always find a company, you'll always find the business that has some level of cash that's lodged with the local commercial banks, and they earn interest on that. Now, interest in Islam is haram, as we spoke. But the way to get around that is because otherwise you not invest in company, in any business. So in order to invest in the business, the guiding principle is that the revenue from that haram source is less than 5%. Take another example. You want to invest in a hotel. Now, the main bread and butter business for the hotel is to rent out rooms to travelers who come around. But at the same time, hotels provide food and beverage to these guests. They also have other facilities where conferences are held or wedding parties are held and so on and so forth. In these food, they can have pork. The beverages, they can have alcoholic beverages. So in this case, what the requirement is that that business should separate the revenue from these non-halal activities, combine it together, and ensure that it's less than 5% of the total revenue of the business. And then make sure that this revenue that comes from the non-halal source is given to charity to purify the dividend income for the investor. Right? So very important. So we have this sample. I've shown you the sample investment universe, which has the MSCI indices, the S&P 5 indices, the Skooks, the balanced portfolios, multi-asset portfolios, and so on and so forth. I'm going to hurry in the interest of time to move along through that. You can have regional funds, developed market funds. You can have North America fund, a USA funds, European funds, Asian funds, emerging market funds, sector-specific funds, funds that focus especially on the healthcare, on technology, on utilities, or on energy, telecom, so on and so forth. So the list is not exhaustible. They have so many different funds that comply with the Sharia guidelines. They comply with the AIOFI screening guidelines that are permissible investments for Islamic investors. The third set of investment funds are the ones that are less liquid. And this could be residential property. You can have your personal residence. You can have investment properties, as long as the mortgages on these properties are Islamic mortgages, not the conventional mortgages. You can have commercial property, office space, restaurants, takeaways, shops, warehouses, etc., etc. Direct investments. You can take a stake in an established small to medium sized enterprise, which is not traded on the stock market. Of course, again, you need to screen them that it's involved in halal activity and it has ethical practices. Take an example, someone producing, say, baby prams somewhere in the Midlands. They need to grow. They are a profitable company, but they need to grow. They need to expand the business. They come to you. You want to put in £1 million in there. You take a 20% stake in the company. That's direct investment. Direct investment. You ensure that they continue to have ethical practices. Venture capital, these are new startups. Someone comes down and tells you that I have a brand new meter that I can, put around these meters around in different places in your garden to track down the rodents that come in at night into your garden. Something you feel that's a great innovation investment, and you put money into that venture capital, and 5 years down the line you float it on the stock market and make tons of money. That's all fine as long as it comes from halal activity and ethical practices. And then you can have startup businesses such as a restaurant or a bakery or takeaway or a delivery service, either yourself or with someone. But if you go down that line, the risk tends to increase. The risk in startup businesses is 50-50. Risk in venture capital is 50-50, 60-40. Direct investments is risk involved. So they're longer term. Yes, the returns will be higher, but the risks will be higher as well. Investor due diligence and monitoring is very important. You, as an investor in Islamic products, you have to be very careful. You have to look at the balance sheet of individual companies. If you're investing in funds, ETFs, Sukuks, you have to check the fact sheets of those. If you're looking to the money market funds that you're going to invest in, you look at the fact sheets. It has to have Sharia. Each one of these investments have their own Sharia boards, usually 2 to 3 Sharia scholars. You have to see that they have approved that. Very important. You also have to see that they declare the non-halal income, which is less than 5%. They tell you what the amount is, and they also tell you what the charity in which it is given to purify the income, the rest of the income. You also have to make sure that this investment you're going to invest in, or this product you're going to invest in, falls within your level of risk tolerance and achieves at the same time your long-term investment goals. So what I have done is I have taken all of this now and I'm going to put it together in a model, which I will show on the next page. But what I want to say at this point is that what I'm going to show you now is a model. If you see, it's called an investment pyramid model. And this model is simply for illustration purposes. It is not a recommendation for anyone to invest in or seek. If you want to seek investment advice, we have colleagues within the group that can provide that advice, and they will be giving you the next two sessions of Islamic investment. Khalid Saab and Tamur Saab, who are certified financial planners, practicing financial planners, FC approved, and they are the ones that you will have to speak to get information, get advice. And they will be coming in and delving more into the depths of these portfolios that this sort of pyramid portfolio that I am going to show you now, which is the model portfolio. And they will then basically allocate your assets, allocate your money according to your investment goals and the level of risk tolerance that you can have. Do that. So, so they'll be looking for that, and then they will perhaps build upon pensions within the regulations of the United Kingdom, and also look into insurance, takaful, which is based on tabarru donations, and they will talk about those also in the next two, three, four presentations that will be made within the Enlightenment group. So let me quickly look at this because Shoaib Saab, how are you doing for time? I have another 5 minutes.
Yeah, if we can maybe just wrap up after this slide, we've got quite a few questions that we want to go
Yes,
through.
yes, I will. I will. So, so basically, what I've done is, if you look at this pyramid, at the bottom of the pyramid, I have shown basically essentially your principal residence, the principal residence where you live, where you hang your hat, where you are. So you're not going to sell that, but obviously you live that. That's a roof over your head. But what you have next to those are the gold, Islamic cash equivalents, cash itself. These are the very liquid instruments in which you can put your money in. These are some things beside your principal residence. This is something you can sell at the moment and raise cash if you need cash. If you don't need cash, they can stay in there. They can earn profit, but they can earn a return, except for gold. But that's there. Then you take a little bit more risk, and dip your toe into the water and see you invest in skooks, balanced skooks and equities, halal equity funds, and so on. Then a little bit more risk because you see the way the pyramid is made. Risk is going up as you go up the pyramid, so does the return goes up. So when you're at the bottom, the return is very low. But as you move up, the return tends to increase. But at the same time, the risk tends to increase. You can also see that when you move up, the investments are less liquid. Less liquid means you cannot sell them right away. It will take time to sell. If you have direct investment or if you are invested in residential and commercial property, you're not going to be able to sell them in a week, 2 weeks, 3 weeks time, unless you know that you have the post-COVID era where everything was being sold because a lot of within weeks because there was a lot of liquidity around. But properties go through their market cycles. In a low cycle, it could take you even 6 months to sell. So you cannot raise money right away from some of these investments as you go up the pyramid. The ones that are below at the lower end of the pyramid, they're more liquid. They're easier to sell. Sukuk funds, balanced funds, you can sell. Then you go into ETFs, halal ETFs, equity funds. They could be, as I mentioned earlier on, country funds, regional funds, large cap funds. They've been provided by several providers like the MSCI, S&P, FTSE, HSBC, Wahid, which is the investment platform. And you can have sector-specific funds in this slot, which is less risky. You can have healthcare, pharmaceutical, utilities, telecoms, consumer goods. These are the areas where the cash flow is fairly predictable in some sense because this is something that everyone wants. This is not discretionary. This is required. Everyone needs to have a phone. Everyone needs to have gas, electricity, and water. Everyone is going to get sick, and you need to have the pharmas supply you with the medications. You need to have clinics. and so on and so forth to go. Then a little bit more riskier is investments in emerging markets, for example, or sector-specific equities, for example, technology, energy, luxury goods, media, real estate investment trusts. These are less liquid. It will take time for you to do that. And they're a lot more volatile. So the risk is much higher in these ones. Then as you go to properties, residential property, commercial property, you got HMO, i.e., you can have those. You can have offices, restaurants, retail shops, warehouses, showrooms, and these are even much less liquid, but the returns can be very high on them. Returns not only from the rental income, but also from the appreciation of property values there. You can have that, the total return concept. Then you have direct investment and private equity that you could invest in. Usually these are 5, 6, 7, 8, 9 years in duration. The IRRs, which are the returns, can be quite higher, but then of course they're less liquid and the risk can be higher too. What if these direct investments don't work? And at the top of the pyramid is things like venture capital or startups, which are even less liquid. The risk of them, working out or not working out, being successful, not successful, much higher. But if they are successful, the returns are much higher as well. And so what I've done is I've just, for a medium risk investor, I've slotted in a bit of asset allocation there so that it's a fairly liquid, risk tolerant, sort of medium risk tolerant level portfolio structure. But again, as I said, it's just an illustration. It's not a recommendation for anyone to follow. But as our colleagues, Khalis and Tamusa, will be talking more in detail on those things because they are financial planners and they understand the UK law much better than anyone else. They will be delving deep into these kind of things and they will be more specific about the portfolios that will build. Portfolios could be a medium risk taker or a high risk taker or even a low risk taker, in which case people will not be investing in the top three rungs of this pyramid. I will stop there, Shoaib Saab.
Jazakallah, thank you very much, Dr. Wasim Khan Sahab. I know that must be challenging given the expanse of this subject. There's so much to discuss, as we spoke about before, so it's very difficult to cram this in within less than an hour. I did want to share some of my thoughts on the things you said, but given the time, and we've got quite a few questions, I think it would be good if we can jump in. Just two quick points before we move on to questions. Before we end, there will be a short poll submitted at the end if everyone can please put their responses on before leaving the meeting. And secondly, as Dr. Wasim Khan Sahab has said, that there have been some questions sort of directly linked to asking for financial advice. So I'm not going to read those questions. As you said, these will be possibly captured in future sessions with financial planners. So please, I will leave those. One of the interesting questions that I like to want someone has asked is, in the conventional economy, we see interest is used as a tool to manage inflation. What tool do Islamic economists use to control inflation?
So inflation is controlled through the money supply. So the money supply is regulated by the central bank. And that, because money supply is a tool, and that tool then is regulated, and that tool then ensures that inflation remains in control, employment increases, the economic growth tends to increase. So it's a regulation of the money supply. So the end object in that is economic growth, employment, control of inflation, by the regulation of money supply. In the conventional sense, obviously, it's the interest rate, as you mentioned.
Jazakallah, thank you very much for that. Another very interesting question is that the Islamic finance has so far played a relatively limited role in promoting equitable wealth and distribution. In many cases, it seems to have replicated conventional capitalist models focused on profit maximization. Where do you see opportunities for Islamic finance to genuinely embody ethical and social responsibility trading practices?
I think the very short answer to that is it's our belief that everything, the ultimate owner of everything in this world is Allah subhanahu wa ta'ala. And we have been blessed with, what He has given us. And on the day of judgment, we'll be answerable to Allah as to how we have used those resources that were granted to us by Allah, and how we have utilized our resources. Have we utilized them for wealth accumulation just for ourselves or our family, or have we been able to help the destitute, the less well off, the needy? Have we been able to help those out or not? So, in that sense, wealth accumulation is not ultimate goal. Ultimate goal is not hakukullah and hakukul ibad. That hakukul ibad, which is basically our obligations to our fellow human beings, how do we deal with them? How do we help them out?
Jazakallah. Um, there was another question as well, which I like. Does Islam prohibit taking on debts or loans, especially the conventional loans and paying interest? And if so, is there any difference between the situation, so allowable debts or prohibited debts under given circumstances? And this can be the example of student loans, a business loan, a mortgage, versus things such as like a payday loan, a personal loan, or even a credit card.
So, Islamic banks do issue credit cards. Islamic banks do issue, but these are not credit cards in the sense that conventional banks do. These are basically charge cards. So you already have money in them and you can use that money. It's a convenience of using that counts. So instead of carrying cash around for security purposes as well, you carry a card around. And if you lose that card, you can call up the bank and tell them they lost the card or the card has been, damaged or something like that. But it's a charge card, not a credit card. You can use that. Um, Going back to the loans from Islamic, yes, Islamic banks do provide loans based upon Islamic principles of profit and loss sharing. For example, mortgages, the person questioned mortgages. We have different types of mortgages. You can have the Maraba mortgage, you have the Ijara mortgages, Musharka and Ijara mortgages that Islamic banks provide. The payoff is very similar to the conventional mortgages, but these are Islamic mortgages, uh, where as you pay the mortgage, for example, you tend to gain a piece of the property every time you pay the mortgage, and the rest is profit for the bank.
Thank you, Jazakallah. It seems like this is a really interesting question because you mentioned that in Islam, money is something that shouldn't just be put under a mattress or just held in one place. It shouldn't be hoarded. Money needs to be in circulation for it to be doing something, right? So then, when it comes to people who hold gold, so as we know in Pakistan, when a person gets married, you buy a lot of gold, and this can be a good investment as well. Someone asked a question is that if gold is good for investment, zakat needs to be paid on it, and how long should you hold on to a gold investment for ideally, given it's going to potentially keep going up in value?
So, gold, precious metals, but especially gold. If you remember that if you hold gold, you need to pay zakat on gold, right? Because it's not being consumed, it's not being used, it's not cash. So gold can be held as an investment. Silver can be held as an investment also, but as long as you pay zakat on that, and you can hold it for as long as you want to. Again, it depends upon what your perspective on the economy is. How is the economy going to perform? What about your business? What about your employment? Are you going to be able to put bread on the table 2 weeks from now, 2 years from now, 3 years from now? So gold then becomes like a saving, like a protection for the rainy day that you may need that money. You know, you could have, again, based upon your investment goals, you can have investments where you want to save some money for the marriage of your child, or for the education of your child, or for buying a house, in a few years' time. So these are all part of that investment process where you keep the money. Yeah.
Douglas, I see someone has also asked this question, which I think would be good for people to understand. How readily is Islamic finance available in the UK? So someone here has asked if they want to take out a loan for studies or build up a small business, what are the options available and are these loans halal? So I mean, how readily is this available in the UK for us, for the average person as well?
Yeah, I mean, if you go with with the Islamic bank, obviously the Islamic bank will go with you on either a musharaka basis or a loan which will be given to you on a cost plus basis, where they will charge you a certain return on that, and you can get the loan to do the business, whether it's a business, a small business, whether it's buying a house or buying equipment, for your business, whatever it is. So the banks will structure that loan for you based upon your requirement, based on how much down payment you have, and so on and so forth, and they can structure that loan for you.
Dr. Sub. If anyone has more questions, please put them in the Q&A box. A lot of people have asked about directly what sort of things they can invest in. And I like this current slide you have up, which provides, I guess, from your perspective, you've given a risk of what's a risky loan versus returns, and these can be fall within halal category as well as non-halal. And you gave a few examples on what things can be halal investments. I don't know if you can maybe if there's some more real life examples that the average, maybe the person here who are looking to start up in halal investing, who might have, investments in non-halal places for now, where they could then start, what's the first thing they can start do to try to move into this, to halal investing?
Right. So the first two or three things are the following. They have to ensure that the business in which they're investing, either if they're investing in the stock of a company, if they're investing in a fund, like any of the mutual funds that you talk about, the UCITS, if they're
Mhm.
investing directly in a business, you have to ensure that business is involved in halal activity, so that the returns are coming in from on your investment from halal activity, that the business is involved in ethical practices, right? And that the business is passing the screens of the Sharia compliant guidelines that have been put forth by the AAIFI and by the Sharia boards. So these are the three basic things that you have to ensure on that. And then, of course, the second thing is that you have to see, again, just as I mentioned the pyramids here, uh, what kind of risk are you willing to take? So if you're a younger person, you may be willing to take more risk. If you're an older person, you want to conserve your capital, take less risk. Okay. If you are somewhere in the middle, then obviously you would follow something similar to what I have presented. Not exactly that. Obviously, your financial planners will tell you what to do. But the underlying criteria as to what you put where is your investment goal and the level of risk tolerance that you have, how much risk you can tolerate.
Okay.
If you want examples, for example, if you want to take a little bit of risk and you say, okay, fine, emerging markets can do well in interest rates are falling in the world. I'm talking about the emerging markets will do well. You invest in emerging markets, Sharia compliant funds. You can invest in energy funds, for example, if you feel that the price of oil is going to rise. If you feel that global economic activity is going to increase and more people will have the money to buy luxury products, you can invest in the likes of funds which invest in luxury goods, for example, be they Louis Vuitton or whatever it is, and media, will do well, and so on and so forth. Technology, like for example, currently technology is doing very well. So just as an example, I mean, other examples could be, as I mentioned earlier on, you could do direct investment, or you could be in a invest in a private equity fund, which will invest in different direct investments in different companies, so that you get the return or part of the return of the overall return on that portfolio. But the thing that you have to be careful is that in each case, regardless of which investment it is, that investment passes the Sharia compliance guidelines.
Mm.
That is the most important thing.
Doctor, thank you very much. I don't know if we've got, maybe we can do one more question. There's been two questions on mortgages. Is what can we do about, mortgages, the conventional mortgage that we have, because if someone has no option, and how competitive are halal mortgages compared to the conventional ones, and are there any pitfalls to be made aware of?
Yeah, so halal mortgages are being provided by banks in the United Kingdom. You got Al Ryan Bank, and you got a couple other banks here that are providing mortgages that are Sharia compliant mortgages that are being provided by these institutions. So if someone wants to switch to those, obviously you have to be careful from the conventional mortgage because you may have early repayment penalties and stuff like that. But if your mortgage is coming to an end with the conventional bank, then you want to switch it over to Islamic mortgage. The best thing would be to approach Islamic bank, and I think that that's where my colleagues Khalid Saab and Tamoor Saab can come in, and they can advise better on that as to which institution or where they can give, they can have access to an Islamic mortgage and for the terms and conditions. So they would be in a better position based upon your needs and requirements, and they can tailor that for you.
Exactly. I think the upcoming talks will be very interesting for a lot of people because a lot of the questions I've seen are directly linked to people asking for specific investment advice. I think we'll have to stop the questions there due to the shortage of time. But I would like to thank everyone for who's come in to listen, who's asked questions, been involved, and a great, very much thank you to Dr. Wasim Khan Saab for your presentation. And as I said, I think you've just barely scratched the surface of what Islamic finance is. I think there's still a lot to that we can learn, understand, and I think it's, for me personally as well, this isn't something I've come across before. Working in risk and compliance almost for the past 15 years, so it's very great to be learning this, and I hope everyone else is really enjoying this and taking something from it. Okay, Jazakallah all. I think we will leave it there, and inshallah, we'll be joining everyone again next week for the next segment of the talks. Assalamu alaikum.
Well, Islam.
Walaikum assalam.